from Arizona is recognized from our office.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. Recent bank failures, particularly the failure of Silicon Valley Bank, highlight the need to address shortcomings by bank managers and bank supervisors alike. I'm pleased this committee recently acted in a bipartisan way to hold failed bank executives accountable. I'm likewise committed to holding federal banking regulators accountable, ensuring regulators fix cultural and operational deficiencies so their bureaucracy never gets in the way of doing their jobs, and protecting the American people and hardworking taxpayers. Today's conversation on deposit insurance is an important piece of the puzzle. When the FDIC invoked its systemic risk exemption authority and protected the uninsured deposits of Silicon Valley Bank, it took action to protect the banking system from contagion risk, but it also upended the incentives to act responsibly by implying that bigger banks would be shielded from the consequences of bad decision making. So my first question is for all the witnesses, and if you would, please be very brief in your responses. Dr. Peter Conte Brown of the Wharton School of Business at the University of Pennsylvania recently proposed increasing deposit insurance for small businesses with less than 200 employees. Conceptually, this idea could have merit, but I'm curious about how it would be implemented for pass-through businesses, where it may be harder for banks to distinguish between personal holdings and business holdings, depending on the choices the customers made. So what tools do banks have to distinguish between the two in this instance?
It's the Senator. It's the most probably complex element of any kind of targeted expansion of or trying to solve deposit insurance reform for a segment, say like business accounts or something that's tag-like. Very complicated, hard to, and it was difficult to figure out when tag was in force back at the after the last crisis. So no easy way to do it. It's something that would require a fair amount of study. I think every practitioner and every suggestion that's out there is going to struggle with that question.
Yeah, I would agree with that as well. You have the definition and monitoring is going to be very important, because otherwise you're going to have gaming that could potentially be created. I think this is something that certainly one could have depositors do some kind of verification or certification when they open their account. But again, that's another kind of administrative burden, and I don't know how necessarily effective it would be.
Yeah, I agree with the other witnesses. This is an acknowledged, I think, challenge to this approach, but one that it does seem feasible.
Well, thank you. My next question is again for all the witnesses. So again, please answer briefly. Do you believe that depositor discipline exists right now? And do people think they'll actually lose money beyond the FDIC guarantee if their bank failed tomorrow? And if so, why? And if not, why not?
I think it depends on the customer and the depositor. We have business owners that have deposit discipline that are worried about deposit insurance limits. And then we have younger customers. We have more vulnerable customers that are counting on us to make sure their deposits are safe, but they're not asking that question necessarily. So I think it depends on the constituency we're serving, but it's also incumbent upon all banks to make sure that our depositors, no matter who they are, know exactly what their deposit insurance limits are. Just briefly, during the crisis back in March, we communicated regularly and proactively with everyone, all of our customer base, as to what their limits were and steps that they could take to ensure their deposit safety.
Yeah, I do believe depositor discipline exists. I think the existence of the run shows that. Now, is it as effective as it should be? I think that's one of the key questions before the committee as it considers deposit insurance reform. As I noted in my testimony, the way banks are resolved right now, just a very small portion of uninsured depositors actually do suffer losses. And so that's in one sense, a positive statistic in the sense that the FDICs are able to resolve institutions without incurring losses, significant losses. The flip side of it is that if there is no risk of loss, again, you've extended the deposit insurance limit far above the 250, and you're creating significant moral hazard over time.
I think the limit exists at what it is to protect the depositors who are incapable or uninterested in providing that depositor disciplining effect. I think SVB in particular showed that we might not have that calibration exactly right. There are depositors out there who are uninsured, not monitoring bank risk, but able to engage in destabilizing runs and have a lot of customer money, including workers' paychecks, wrapped up in their behavior.
Thank you. Mr. Chair, I know